Hello, welcome back to Plus and Minus. Right, let's get cracking. This is business A level again, accounting rate of return, also known as AAR, type of investment appraisal. Sorry, it's in accounting and finance chapter. So let's get onto the pluses. So with an AIR, it takes into account the cash inflows throughout the life of the investment. This is something that you don't get in the payback method. So this is an advantage of the accounting rate of return. Why? Well, if you know when the cash inflows are going to occur, then this helps you. It makes it easier to calculate your cash flow problems. And obviously, we said about this earlier, when a business is making investment, cash flow is massively important, because if they need to get a loan or an overdraft, then banks are going to want to look at their cash flow. Another advantage is that it measures the profitability of the investment. So again, this is massive. In the payback method, it didn't do this. And again, this is really important when a business is making an investment. Yes, they want to know when they're going to get paid back, but they also want to know how much money the investment's going to make. Otherwise, it's pointless in doing it. And then it's relatively easy to calculate. Again, this is similar to the payback method, so because it's easier, more employees can do it, it takes less time, and it can save costs. Furthermore, it allows the simple comparison between the two investments. So when you're comparing data, this makes it a lot easier to decide which investment to go for, and this can be crucial in business decision making. Right, that's quickly done. Onto the minuses. So it ignores the value of money over time. This is a limitation in payback method and the ARR method. We said before, if it ignores the value of money over time, then it's not going to be accurate. It's not going to be reliable, is it? Because the cost of, like I said before, this pen costs 50p now. 10 years ago, it cost 20p. So it's all about, the other way around. This pen might have cost 50p. You could have sold it for 50p, but nowadays you can only sell it for 20p, so you're going to make a loss. Yeah? Have I got that right? Oh, who cares? Anyway, there's no indication of when the cash inflows occur within any given year, so this again is a limitation, because you need to know this. Furthermore, life of the investment must be known. So to calculate this, you need to know precisely how long this investment is going to last. And 9 times out of 10, businesses do not know. They're just educated guesses. And this obviously impacts the reliability and the accuracy of the calculation. So that is therefore a limitation. Furthermore, it's harder to calculate than payback method. This is deemed as a limitation. In my eyes, it's still not that hard to calculate. If you're working in the business world, you should be able to do simple maths like this. It does take a little bit longer, but in the long run, not that much longer. So yes, if you're struggling for points, say that it's harder to calculate than payback, and you can expand upon that. But I wouldn't say it's your first point, because you could quite easily counter-argue that. Anyway, that's it. Next video will be on net present value, which is the last of the investment appraisal. But for now, subscribe and whatnot, and see ya.